An ETF can legally make a tax bill smaller, or at least push it far into the future. But what happens when the tax benefit becomes the main product being sold? That is the question Treasury and IRS officials raised on July 21st, 2026. They identified several ETF-based strategies that may produce results they consider too good to be true. The list included Section 351 conversions, box spread ETFs, and unusually aggressive uses of in-kind redemptions. Here is the first thing investors need to know. No new rule was announced. These strategies were not suddenly declared illegal, and officials did not say the normal tax efficiency of ordinary ETFs is the problem. This was a public warning that certain specialized uses of ETF tax rules are being examined, and that guidance or enforcement could follow. To understand the concern, we need to start with the perfectly ordinary mechanism underneath it. Imagine a fund bought a stock for $100, and that stock is now worth $180. If the fund sells it, the fund realizes an $80 gain. In a taxable account, that gain may eventually be distributed to the fund's shareholders, even to people who personally did not sell their fund shares. Many ETFs have another option. When a large financial institution, known as an authorized participant, redeems a block of ETF shares, the fund can hand over a basket of securities instead of selling those securities for cash. This is called an in-kind redemption. Under Section 852(b)(6) of the tax code, a regulated investment company generally does not recognize a gain when it distributes appreciated property as part of a qualifying redemption. So the ETF may be able to hand the authorized participant that stock worth $180 without realizing the $80 gain inside the fund. The ETF can often select securities with large embedded gains for that redemption basket. Those gains leave the portfolio without creating the same taxable fund distribution that a cash sale could create. That does not mean the regular investor has discovered tax-free investing. Dividends can still be taxable. If you bought an ETF for $100 and later sold it for $180, you would generally have an $80 gain. The ETF structure mainly reduces the chance that another shareholder's redemption, or the fund's internal trading, creates a capital gain distribution for you. That distinction matters. Ordinary ETF tax efficiency helps prevent one investor's activity from creating an unexpected tax bill for everyone else. Treasury's concern is what happens when the same plumbing is deliberately arranged to change, defer, or avoid taxes on transactions that look economically different. If clear explanations of investing mechanics are useful to you, consider subscribing. We focus on what financial products actually do, including the risks hiding behind the sales pitch. The first strategy under scrutiny is the Section 351 ETF conversion. Suppose an investor owns a diversified stock portfolio worth $1 million. The investor originally paid $200,000, so there is an unrealized gain of $800,000. Selling everything would realize that gain. At a simplified assumed federal capital gains rate of 20%, ignoring state taxes and other federal taxes, the immediate bill could be about $160,000. Section 351 can allow property to be transferred to a corporation in exchange for its stock without recognizing an immediate gain, provided strict conditions are satisfied. In an ETF conversion, investors may contribute qualifying portfolios to seed an ETF and receive ETF shares in return. If the transaction qualifies, our investor could exchange the $1 million portfolio for $1 million of ETF shares without realizing the $800,000 gain that day. But the gain has not simply vanished. The investor generally receives a carryover basis. In this example, the ETF shares may still have a basis of $200,000. If the investor later sells those shares for $1 million, the deferred gain may become taxable then. The immediate attraction is diversification without first writing a large tax check. The investor moves from an old portfolio into one ETF, while the ETF can gradually adjust its holdings. When appreciated contributed securities leave through in-kind redemptions, the fund itself may avoid recognizing those gains. This is where Treasury appears to be drawing a line between a legitimate conversion and a conversion engineered mainly as a disposal system. Officials reportedly acknowledged that Section 351 contributions can remain viable when the contributed assets fit the ETF's investment profile and the fund disposes of assets in its ordinary business. Their concern includes structures where appreciated securities are contributed and then intentionally pushed out through redemptions so the ETF can rapidly replace them. Also, Section 351 is not a simple way to swap one highly concentrated stock for a diversified ETF. Transfers to investment companies face special rules. A contributed portfolio generally needs to satisfy diversification requirements, including limits involving the largest holding and the 5 largest holdings. Structure, timing, control, and the assets being contributed all matter. The second strategy involves box spreads. A box spread combines 4 options with the same expiration date. When properly constructed using suitable options, the final payoff is fixed regardless of whether the market rises or falls. Economically, it can behave more like lending money than betting on stocks. For a round number example, imagine paying $950 today for a box spread that pays $1,000 in 1 year. The $50 difference produces a return of about 5.3%. That resembles buying a Treasury bill at a discount and receiving its face value at maturity. But the tax character can look different. Treasury bill interest is generally taxed as ordinary income at the federal level. Certain index options receive special tax treatment, and an ETF may try to use in-kind redemptions so option gains are not recognized inside the fund. Instead of receiving regular interest distributions, an investor may see the ETF's share price rise and potentially report a capital gain only when the shares are sold. In plain English, the economic engine can resemble interest, while the desired tax result resembles deferred capital gain. Treasury is now questioning some ETF structures that use Section 852(b)(6) to avoid recognizing gains from box spread options. Some fund disclosures have already warned that the IRS or a court could disagree with their interpretation of the non-recognition rule. This does not mean Treasury said box spreads themselves are abusive. Box spreads have long been used as financing tools. The question is whether putting them inside an ETF and combining them with in-kind redemptions produces a tax result that Congress did not intend. Officials also mentioned other specialized structures. One involves an ETF holding other ETFs and distributing those shares in kind before receiving taxable income or gain distributions. Another involves assets, such as cryptocurrency, that may not generate the type of income normally required for regulated investment company status. Officials also discussed products designed to generate capital gains alongside ordinary losses, which can be especially valuable because ordinary income may be taxed at a higher rate. So, what has actually changed? As of July 25, 2026, the clearest change is regulatory risk, not the written tax rules. Treasury and IRS officials said they were evaluating the tools available to them and requested information from the investment management industry. They also indicated that they wanted dialogue before their positions became fixed. No formal rule, notice, or blanket prohibition on these ETF transactions was announced at the July 21st meeting. That uncertainty matters most for fund sponsors, wealthy investors planning Section 351 conversions, and investors choosing specialized products because of a specific tax claim. A later interpretation could change how a strategy reports income, force a fund to modify its portfolio process, create larger distributions, or reduce the advantage that justified the fund's fees and complexity. For someone holding a conventional, broad market ETF, the immediate read is much less dramatic. Officials reportedly recognized the continuing importance of normal in-kind redemptions to ordinary ETF operations. That suggests the current focus is on aggressive combinations of rules, not on eliminating the basic ETF structure. Investors using retirement accounts are even less directly affected by annual ETF tax efficiency, because trading and fund distributions inside those accounts are generally not taxed in the same way as activity in a taxable brokerage account. The biggest misunderstanding to avoid is assuming that a tax-efficient product and a legally guaranteed tax result are the same thing. They are not. A product can follow a disclosed strategy while its tax treatment remains uncertain. And words such as deferred, tax-aware, and capital gain-oriented do not mean tax-free. If you own or are considering one of these specialized ETFs, the useful question is not simply, is this legal today? Ask whether the investment still makes sense if its expected tax treatment changes. Check the tax risk section of the prospectus. Look at the fee, the underlying economic exposure, liquidity, and what could happen if many investors leave at once. For a large Section 351 transaction, individual legal and tax advice matters because qualification depends on facts that a general explainer cannot determine. Treasury has put these strategies on notice, but it has not yet drawn the final boundary. Until it does, the normal ETF tax advantage remains different from the more ambitious strategies built on top of it. If there is another ETF tax mechanism you want unpacked, leave it in the comments, along with any questions this explanation raised.